Money laundering, in a nutshell. Al Capone already knew that money earned with a laundrette is easier to tax than money earned from drug trafficking or extortion. Money laundering is a process in which illegally acquired assets, for example money from drug trafficking, are introduced into the economy in an inconspicuous manner through legal transactions. In short, money laundering is a process in which dirty money is processed into clean money. This can be done in different ways, typically through offshore accounts, chains of banking transactions where small amounts of money are deposited, company participations, and so on. It is, however, also possible to buy goods with dirty money, which are then sold for clean money. Here, the money laundering risk also affects traders of goods. The overall economic damage caused by money laundering is enormous, and the legal pressure to prevent money laundering is increasing. Deutsche Bank recently paid a fine of around €600 million for failing to comply with its obligations to prevent money laundering. And banks are not the only ones subject to legal obligations to prevent money laundering. Among others, traders of goods, real estate agents, financial service providers, or investment companies must also introduce internal procedures to prevent money laundering. Unfortunately, you can't tell whether money is clean or not just from the glimpse at it. Knowing your customers is therefore an important instrument to protect yourself from money laundering. Consequently, the Money Laundering Act requires that affected companies introduce so-called Know Your Customer processes within the framework of which they check the identity and, if necessary, the background of their business partners. When this has to be done can be different depending on the situation. For traders of goods, if a customer makes a cash payment of €10,000 or more per day in one transaction only, or by means of several smaller payments on the same day, the customer must be identified by means of a valid identification document, and the transaction must be documented. Even below the €10,000 threshold, it may be necessary to identify the customer and document the transaction. This is always the case when the situation is suspicious, for example because the transaction is unusual for the customer, as the customer usually spends €200 per purchase and suddenly buys regularly for €7,000. The client holds a high political office or works for an embassy. The customer buys products that obviously do not fit his business. The customer is not the owner of the customer card and refuses to identify himself. Or the situation as a whole is suspicious, for example, because the customer stays longer in the checkout area for no reason, without actually going to the checkout, avoids eye contact, behaves strangely, etc. Finally, caution is also called for in the case of new customers if they make contradictory statements about their business and the beneficial owner, or do not disclose any standard information in the due diligence process. As a general rule, suspicious transactions may not be carried out without the approval of the Legal and Compliance Department. Approval shall only be granted after verification and approval by the competent authorities.